Hey friends, I want to share a stock today that offers massive bill paying power. I use this stock right now every single time that it pays a dividend to pay my bills. When I look at my overall dividend stock portfolio, I believe this might be the best position that I own for paying bills. I want to explain why in the video today. The stock, if you're wondering, is Universal Corporation, ticker UVV. I think I first talked about this stock or last talked about this stock on my channel a number of years ago. Many people have never heard of this company. They don't make movies. This is actually the Universal that farms the leaf that's used by the other sin stocks that I own. Now, I can explain this stock best via analogy, but then I'm going to jump into all the numbers today because I have a lot of financial analysis to share that explains my position on this company. But first, the analogy. I'm wearing a jacket right now. This is a leather jacket. This was very expensive. I purchased this probably over 15 years ago. It's a Xenia jacket. So Xenia, expensive brand, luxury brand, leather jacket. I rarely wear this thing. I really do. I rarely wear it. Why? The color is light and it could get stained very easily. And also I spent a lot of money on this thing. I just don't want to mess it up. And so I don't wear it. That being said, if you've seen my multitude of videos here about dividend stock investing, I've worn so many jackets over the years. Some of you may remember this one. I think I wore it once or twice in my earlier days. Put in the comments below if you remember, but usually I just wear my tried and true normal day-to-day outerwear. Let me explain why this analogy is so important. I have stocks that are like this jacket. I do. There are stocks like StarBucks, for example, my number one position, SBUX. It's like this jacket because I cannot spend the dividends. Every time I receive the dividend, I always reinvest it. I want to keep Starbucks pristine. It's my number one position. I want to reinvest that dividend. Who knows if I'll ever have the ability to turn off reinvestment and spend those dividends. It would be almost painful to do so for me because it's Starbucks. That being said, I have stocks like Universal. Every single time I get a dividend from Universal, I don't care if I spend that dividend. I don't need to reinvest it. I don't need to look at Universal and kind of baby it or pamper it or treat it special. No, it's Universal. I love spending the dividends. That's why the analogy to this jacket versus just a normal jacket makes so much sense. Sometimes in life, I wonder, am I just better off with the normal jackets or the kind of everyday stocks like Universal because they make my quality of living better? I can just spend the dividend from Universal, no problem. And so that is interesting food for thought. And that's part of my thesis these days around best stock for bill paying power. Not only does it offer a massive 5.8% dividend yield, but also I have no problem spending that dividend. I have a lot of ground to cover in the video today, everyone. Get ready for an exciting dividend stock investing video. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone. So I want to start out with some of the metrics. Check it out on the screen in front of you right now. These are the metrics for Universal. My patrons already know about this, and I will link to it in the pinned comment below. But I've been sharing my trades on Patreon, and those trades include Universal. I've been buying it this year. It's a strategic focus of mine this year because it provides massive bill-paying power right now. You can see that it's 15.6% off the 52-week high, and it's trading at a PE based on trailing 12 months EPS of 15, and it's trading at a massive, a staggering dividend yield of 5.8%. The reason I like this dividend yield so much is it's qualified dividends. I just did a series of videos on basically income investing, high income investing, high yield investing, and I featured guest Greg in 2 of those videos. Then in the 3rd video, I did a book review of the book that Greg suggested, The Income Factory. These types of strategies that are really high yield focused, typically those distributions, they're not going to be qualified dividends. Typically they're taxed as ordinary income in a lot of the cases. I like Universal because this dividend, this distribution of 5.8%, it's a little higher than it looks because it has the tax status of qualified dividend, which is so wonderful. But let's keep going. As you can see on the screen in front of you. By the way, I will link to those recent videos with Greg and my book review of The Income Factory in the pinned comment below. The stock has a higher payout ratio of 88.3%. On a go-forward basis, I do not expect this company to increase the dividend very quickly. It probably will be 1 penny in terms of the quarterly dividend per year. Now, the 5-year dividend growth rate is 7.5%, but that's because they did a big function step growth kind of raise in the dividend a few years ago to bring it up, I guess, to size. Going forward, I would expect about a 1.2% dividend increase per year going forward. That being said, I don't need the dividend to grow. It's providing massive bill paying power for me right now. Market cap is small. It's 1.33 billion, but keep in mind this company has been in business over 100 years. The stock chart over very long periods of time, if Stephen Bavaria were looking at this stock, I just read his book. I'll link to the book review in the pinned comment below. He might classify this stock as Income Factory Light. It's a dividend growth stock, but it offers a high starting yield, slow dividend growth, but over very long periods of time, it offers capital appreciation, as we can see in the max chart below. But in the shorter period of time, the 5-year chart on the right, we can see that it has flat lined. I'm going to get into the metrics today so that you can see why this particular company has flat lined in terms of its stock equity growth. But first, I want to talk about the balance sheet. Boy, not a lot has changed with this company. In fact, let me take a step back. I was recently talking to Greg on Instagram. By the way, check out the pinned comment. I'll link to my Instagram. I share so many fun stories over there all the time. Please connect with me on Instagram. It's so much fun. But I was chatting with Greg on Instagram. Greg is my friend that just retired on high yield investments. And I was talking about high yielders, and I'm like, hey, there's a higher yielding dividend stock, qualified dividends, that I've been buying again. It's Universal. And I wanted to share with Greg, hey, here's what it's all about. And so I went onto YouTube and I typed in PPC Ian UVV. YouTube search algorithm is so good that it brought up the video that I did a while ago. I'll link to that in the pinned comment below. It was from a number of years ago, and I rewatched my own video. And what's so funny is a lot of what I'm sharing today, it is similar to what I shared all those years ago, but I'm adding a few new nuances today because I've grown as an investor since then. But my takeaway was not much has changed. It's a boring company. The company is doing the same thing it was doing a few years ago, more or less. It had a little bit of a dip during the pandemic. I'll share that in the metrics analysis today. But more or less, same old boring company. Not a lot has changed. When I am looking for massive bill paying power, there is so much that warms my heart when I see something like that, that it's just the same old thing, same old story. And so that was so fun to take a trip down memory lane. And I will link to that in the pinned comment below. But let's keep going. As you can see on the screen in front of you right now, I want to talk about the balance sheet a little bit. I'm going to get into this in more detail, but you can see the high-level summary here. As of September 30th of 22, you can see they have 2.8 billion in assets, 1.45 billion in liabilities. And if you take assets, you subtract out liabilities, their book value is 1.35 billion. But we know from the left-hand side of this screen that the market capitalization is 1.33 billion. This is awesome because it's basically trading at book value. If this company just went out of business and they had to liquidate everything, they have more than enough assets to pay off liabilities, and basically presumably investors would just get their money back if they were able to sell their assets as they are carried on the balance sheet. But it gets more interesting. They actually have something on the balance sheet under assets called accumulated depreciation. It's actually represented as a negative number. It's represented as a negative number on the balance sheet as a negative $643 million. But really, is that depreciation real? I know they have a lot of equipment in the business that they run, their farming business, but has that equipment depreciated this much in reality, or is this just what the tax code has allowed? And does that equipment still have more of a useful lifespan than maybe the tax code would imply? Perhaps if we add back that accumulated depreciation and we don't really look at it as a negative number, potentially the delta between assets and liabilities could be as high as 1.99 billion. Now, there was some goodwill under assets as well, maybe like 200 million. So I take that out and maybe that brings us down to like a 1.79 billion in book value. Long story short, I believe the book value is at least as high as the market capitalization, if not higher, which tells me I've got a stock here that's paying a huge qualified dividend. I have a stock here which is probably not going to go out of business anytime soon. I'm going to talk about that a little bit at the end of the video as well. I have some summary of the pros and cons of this position. I have a company over long periods of time that is growing the equity value. And I have a company that has probably trading at lesser than its book value. Now, this tells me in a lot of ways, this has parallels between some of those closed-end funds that I was discussing in the last video when I was reviewing Stephen Bavaria's book, The Income Factory. A lot of those closed-end funds, I actually bought one of them. Surprise, surprise. I shared that on Corner Patreon, by the way. Check out the pinned comment for Corner Patreon. I'm doing so much over there. I've actually announced my next Zoom book club. We're going to be meeting up in a few weeks here to go through the second book of the year. Book club meetups there are so much fun on Corner Patreon. But it's so interesting because there's so many parallels between this and the closed-end fund universe. The closed-end funds oftentimes trade at a discount to the net asset value. I believe, quite frankly, that not only is Universal here paying out a healthy dividend, but it also is trading at a discount in some ways to its net asset value. And so how cool is that? I look at this as a bond-like proxy, a bond-like stock. This is an income factory type stock. I'm doing this video today, quite frankly, because I've been inspired by the Income Factory. I've been inspired by Greg. I'm looking for some ways to generate more yield in my own portfolio, but I want to do it my way. I don't want to really go against my core principles as an investor. And one way I'm doing that is I'm just searching my own portfolio for Income Factory light style investments. And I think Universal may be the most massive bill paying stock I have in my portfolio. But let's continue. As you can see on the screen in front of you right now, I want to share the balance sheet from Universal. And this is from September 30th of 22. That's the last one I was able to get my hands on. And I want to go through the assets and liabilities. First here, you can see the assets, and you can see, I want to just go through and prove to myself and to those watching that I think this thing actually is trading at or below book value. Real book value, that is. You can see they've got a bunch of cash. Of course, that's worth a lot. It's down a little bit from the last year period, but I think it's because this is a very working capital intensive business. And they've done a lot of farming. And now that they've done all the farming, it's time to sell their product. And it sounds like on their recent shareholder update, which I'll share with you today, they are having kind of all of their backlog sold. And so it's a lumpy business. It's a working capital intensive business. We'll get more to that later. Accounts receivable is way up from the year ago. $469 million. I mean, that's insane. That's a huge amount of accounts receivable. Just look at that as compared to market cap. It just goes to show how working capital intensive this business is, how lumpy it is in terms of kind of cash flow and revenue coming through. But they're selling a product that companies much larger than them need to buy, and they've been in business over 100 years and have very established relationships with their partners. Now, they've done some advances to suppliers as well. These numbers are up. Now, could their partners not pay them? Possibly, but again, my belief is the cash-heavy sin stocks will have no problem paying them. Now, they have huge inventories. Based on my understanding, most of those inventories are now spoken for, and it's a lumpy business, so they're carrying a lot of inventories as of September 30th, but now they're going through those inventories. There's a cycle to the business. It's a cyclical business, so it's a little difficult to understand, but I believe those current assets, at least of $1.9 billion, those are real. I don't see any reason not to believe that those are real genuine assets that they could get that value for. They've got some land, they've got some buildings, they have machinery and equipment. I believe all of that is real assets as well. That adds up to about $984 million. But you can see they subtract out accumulated depreciation. I wonder if the depreciation they've taken against their land, buildings, and machinery and equipment is the tax depreciation. And in reality, there's more of a useful lifespan against those assets than we think. I think so. That's the point I was trying to make on the last slide. That's why I actually think this thing may be trading below book value, which is so exciting as a value investor. Now, you can see here under other assets, there's some stuff here where, hey, is it real? Is it not? Maybe actually up to 300 million is not real because you've got some goodwill there. You've got some intangibles. That adds up to roughly 300 million and of just there. And so that's something to keep in mind. But again, I think that the depreciation more than would make up for the intangibles, lack of potential value at intangibles. Long story short, I think the asset side of their balance sheet is solid. It's strong. I believe in it. This is the same message I had all those years ago when I looked at it then, and that's why I love companies like this. Let's keep going. As you can see on the screen in front of you right now, the next slide that I want to share is the liabilities and shareholders' equity. You can see in terms of liabilities, obviously all of this is real. Usually when I'm looking at assets and liabilities, when I'm looking at a balance sheet, I try to be critical of the assets. Liabilities, I just kind of take as face value. Hey, they're liabilities, they got to pay it back. But you can see here, in particular, what I want to highlight on liabilities, that they have a lot of long-term debt, especially as compared to the scale and size of their business. And so that's one potential concern I have for this company, especially with interest rates at higher levels than they've been in a long time. That's something that they will have to keep in mind. But you can see all the way at the bottom, that's where I get the stockholders' equity of $1.35 billion. Which is just a little bit higher than their current market capitalization. And so very exciting to see. By the way, if you enjoyed the video so far, please go ahead and click that like button. It really, really means the world to me. I want to now go through their investor presentation. I have some slides I want to go through. A lot of people, they don't even know what this company does. I want to share why I'm so excited about this company. Of course, this is a smaller ancillary position in my portfolio. It's not a huge position, but it is a position that I'm adding to right now in 2023. And it's actually one I will probably be buying regularly, maybe monthly throughout the year. I want to build this position because I like the bill paying power that it offers me right now. Let's keep going. As you can see in front of you right now, the next slide is just, what does this company do? Well, they provide the leaf that's used by the SIN stocks. They were founded in 1918. A lot of people are surprised to hear that. They've been in business over 100 years. Their revenue annually is roughly $2.1 billion, but their market cap is only about $1.1 billion. Well, now it's 1.3. When they did this slide, I guess it was 1.1. The dividend yield there is listed as higher than the current one because the stock is appreciated. Now, many people may not know this, but they've been increasing the dividend for over 50 years. Over 50 years of consecutive annual common stock dividend increases. So this would actually be a dividend king if it were not for the fact that the market capitalization, I believe, is lower than the threshold for being a dividend king. They're in over 30 countries. So this is a company that is operating at scale. And we all know how important farming is to our society right now, whether you're farming the leaf that's used for SIN stocks or really farming anything. And they are doing business in over 30 countries. But let's keep going. As you can see on the next slide, what I want to go through next, this is actually, you can find this on their website. This is from their recent investor deck. And they talk about their capital allocation strategy. The reason that I want to highlight this slide right now is really for bullet point number 2. The number 2 thing that they are doing with capital is increasing their dividend. This is a shareholder-focused company. This is a dividend-focused company. This is a company that is in business to pay the dividend. Much like the types of income factory funds and investments that Stephen Bavaria makes, this company is in business really just to generate cash flow for shareholders like myself. And also worth noting, I'm going to start talking about this right now, they are looking at ways to diversify their business into other businesses to hedge against the potential declining industry of their core business of the products that SIN stocks make, because we know that's a business that is potentially in decline over long periods of time here, not only in the US, but globally now as well. So that's their capital allocation strategy. Certainly, there are risks that come with this potential investment. And for me, I understand the risks. I live the risks. I have come to terms with the risks, but I've shared two of them so far. One of them is the high debt stack. Another one, quite frankly, is the fact that their core business overall, the demand for that product is in decline over time, not only in the US, but globally. I guess the third risk I've talked about so far is that their business cycle involves a lot of working capital, and there's kind of these lumpy periods where they're spending a lot and investing a lot to harvest their crops, and then they make a lot when they sell those crops to the end user. But let's keep going. As you can see on the next screen, I want to share how do they do in the first half of fiscal 2023. They're on a fiscal year. And we can see, just looking at the numbers on the right-hand side, that, well, good, revenues are up, EBITDA is up, operating income is up, adjusted operating income is up, segment operating income is up, net income is slightly up, adjusted net income is slightly up, so it looks like they're headed in the right direction, but I will say that 2020 and 2021 were tough years for them, and if we actually comped this against 2019, it's not looking so good. In fact, it's flat to slightly down, and so they did face some challenges during the pandemic, like many businesses did. I would not be surprised, quite frankly, if it's due to some of the shipping issues over the last few years as well. I reviewed a stock on my channel. I'll link to the video review in the pinned comment below. I don't own it, but I reviewed Hapag-Lloyd, one of the shipping companies, and they've had just an incredible few years here because of the cost of global shipping. I wouldn't be surprised if that's affected these guys a little bit. Obviously, the cost of labor and doing business overhead has increased as well with inflation. But what I like to see here is their inventories were nearly 90% committed for sale as of September 30th, 22. So we know that those inventories on their balance sheet on the assets are real and they are more or less committed to. And we also see here their through peak seasonal working capital requirements, good. And they are already seeing significant working capital receipts in October of 22. And so this really shares and foreshadows how this company is going to end up in fiscal 23, and it shows just how lumpy things are in terms of their earnings. They spend a lot of money, they have to sell their product, then they make a lot of money. And so it's a lot different than producing widgets like a company I own, like Procter & Gamble, for example, that they just kind of have a constant factory going and they're selling evenly throughout the year. This one faced cycles. It's a cyclical business that they have. If you enjoyed the video so far, by the way, I have so many videos here on YouTube, I can't even count them all. I have new videos on the way all the time. And please go ahead and subscribe so you never miss a new video. It means the world to me. If you appreciate these videos and the effort that I put in, those subscriptions, those likes, I sure appreciate them. And I try to respond to all the comments below as well. But let's keep going. As you can see on the screen in front of you now, a fun game at home, by the way. Every time I say, as you can see on the screen, please do go ahead and keep count. Someone should put in the comments below. I do that just to help myself edit these videos. I edit them all myself. It's a lot of time. It's a huge investment on my end. So thank you for bearing with me. Their fiscal outlook for 23, for the fiscal 23, as reported on November 3rd of 22, boy, that's confusing, but this is for fiscal 23, is shared on this screen. And you can see here, I don't want to go through every point, but one thing that stood out to me is while we are still having some shipping challenges, we're encouraged by the global easing of shipping constraints. That stood out to me because I think one of the reasons that 2020, 2021 were so difficult for these guys as compared to 2019 was probably because of global shipping. One thing I want to share here as well is they're getting into this new ingredients business that is kind of different than their core business as a way to diversify. I get a little scared about that because who knows if that will pan out or not. Is it just a waste of shareholder money, or in the long run, will it pan out? Only time will tell. Only decades into the future will tell, but they're showing that the ingredients operations is seeing inflationary cost increases. They don't talk about that for their core business. They talk about it for their new business. And so is the new business even going to make any money for them? That's a concern of mine with this, but I'm going to give them the benefit of the doubt. I'm a long-term shareholder. I've been in this stock a really long time. I'm just going to keep holding and I'm going to see what happens there. But that's another potential risk, but I think they are doing the right thing trying to diversify. I like that they say also we expect a considerable reduction in debt levels over the next 2 fiscal quarters. I have a few more slides I want to share before I get to my summary. I'm taking a deep dive here because I don't know if anyone on YouTube covers this stock. Put in the comments below if you've ever even heard of this stock before. If you own it, boy, put that in the comments as well. As you can see on the next slide, I want to share a few more metrics. You can see their financial results, and this is by fiscal year. And so this goes through fiscal 22. We know we're in fiscal 23 now. And this is what I was trying to say. Revenues more or less are fine. We're in line with fiscal 18. We're a little down from 19, but we're up. This is where you see 2020, 2021 were tough years. But you can see here, there are some challenges with this business and it does contain some risk. And so in particular, well, EBITDA looks good, quite frankly. EBITDA actually is the highest of the bunch, but the operating income, quite frankly, is lower than it was in fiscal 18. It's on par, $1 million lower than 19, but at least we're back up to 19 levels. 2020, 2021 were not great years. But when we drop all the way down to net income, boy, we're still below those 18, 19 numbers considerably. And it looks like fiscal 22 was in line with fiscal 21. And so what's going on? Well, 18 had a really strong operating margin, so we're generally seeing margins go down. We're also seeing, well, why are margins going down? Well, SG&A, sales general and administrative, is going up. It's higher as a percentage of sales. At least 22 is lower than 20, but it's still higher than it was in 18 and 19. So we're seeing a business get squeezed a little bit here. And in the long run, will the margins come back? Will the net income come back? That's a potential risk. It looks so far like it is. Let's keep going. As you can see on the screen in front of you, the next one I want to share is more financial results. You can see adjusted EBITDA over time. Actually, this is looking pretty darn good. 2022 was the best adjusted EBITDA of the bunch. But in terms of free cash flow, it was not. We are still lower than 2018. We're better than 2019. We're better than certainly 2020, 2021. The key here, the pivotal year, will be to see what happens in fiscal 23. Will we surpass 2018? One of the challenges is the debt levels are higher now. Perhaps that's because of the acquisitions they're making. Perhaps that's just because of the cost of doing business recently. And it's been really high. But their debt to capitalization is the highest of the bunch. That's an alarming statistic, quite frankly. That's one that scares me a little bit. And so that's something to keep in mind. And so we started the video today with a stock chart. I loved how over very long periods of time, it was growing slowly, but it was growing in value. Over the last 5 years, it's been flat. Why is that? The stock is a reflection of the performance of the business. The business has been stagnating a little bit. We know from the last video where I reviewed the income factory that sometimes a stagnating stream of income is fine. As long as Universal more or less can just keep doing what they're doing in perpetuity, and I think they can. I know they're trading slightly below book value, which is awesome. And I know that they're paying a hefty dividend. So that's fine. Just kind of a Stephen Bavaria perspective on all of this. That's how I look at it. But being the dividend investor that I am, who does like to have some growth over long periods of time, that stock will only start growing in share price again as the company starts growing in fundamentals. If the fundamentals stay in this range that they're in, the stock is not going to appreciate. And they're not going to be able to increase the dividend as much. If the fundamentals start improving a little bit more than they have, and 23 could be that pivotal year, I believe that that long-term trend in terms of the stock chart could resume. But I want to summarize everything for everyone. Put in the comments below what you think about this stock. Do you ever invest in stocks just for the dividend alone? Do you ever invest in these companies where you don't mind just using the dividend to pay bills? Do you like stocks like this where they're kind of bond-like? They're trading potentially at or slightly below book value, but they just pay a good dividend and hey, it's fun just to pay that dividend for living expenses, share in the comments below. Here's my summary. As you can see on the screen in front of you right now, I want to go through a few key points. What do I like about this thing? Large qualified dividend of 5.8%. They're committed to paying the dividend. I believe it's trading at or possibly below the book value. I believe the accumulated depreciation may hide an even higher possible true book value. I believe also, point 4, this is key. I own a lot of sin stocks, and the problem with the sin stocks is they're always the target of someone out there trying to go after them because they're sin stocks. They have deep pockets and society doesn't like them. I believe Universal is in the industry of sin stocks, but they're one step kind of removed from that drama, so they're shielded a bit from the drama. I almost like Universal here more than I would in Altria, for example. Just my personal opinion, though. Let's keep going. As you can see on the screen, point number 5, I want to share that I use the income to pay the bills. I think I've said this more than a few times today, but I never worry about spending my Universal dividend. I don't spend my Procter & Gamble dividend. I don't spend my StarBucks dividend right now. Even Altria now I'm reinvesting. Universal, I just don't mind spending the dividend. There's something about it. It is a paying bill type company. It's a trading range stock. This one typically bounces in a trading range, and I like to buy it when it's towards the bottom of the trading range, being about 14% or so off the 52-week high. It's not at the bottom of the range, but I'm happy to buy it here. Small business, but they've been in business over 100 years. And it would be a dividend king, quite frankly, if it were not for the smaller market cap. Now, what's the risks? It's in a shrinking industry. Earnings have stagnated. Stock prices stagnated because the earnings have stagnated. Acquisitions. Is it even going to work out? Will their plant-based ingredients platform work or fail? They're putting a lot of effort and money into that, money that could be used to grow the core business or to return more cash to shareholders. I generally like what they're doing there, but with that type of strategy, it's always risky when you're trying to reinvent your business. Yeah, it's related, plant-based ingredients. It's kind of a related industry. That being said, they're even saying in that industry they're seeing inflation there. They have a good amount of debt, long-term debt. Their debt to capitalization is growing. Will that resolve itself in the next few years? I hope so with the high interest rates. They have lumpy results throughout the year. It's a little more difficult to analyze this type of company. And honestly, they're generally doing worse than pre-pandemic times. At least through fiscal 22, they're doing worse than pre-pandemic times. But let's see how they do in fiscal 23 and fiscal 24. Can they surpass the performance they had during the pandemic? I hope so. I think that inflationary pressures are going to ease here. I think that interest rates here are going to stabilize, if not start tapering off. All of these would be very positive signs for this particular company. I'm so appreciative of all of you out there who watch my videos. I hope you have the best 2023 ever. Before we leave today, I want to highlight again, I am putting so much effort right now into Corner Patreon. I'm doing so much over there. Check it out in the pinned comment below. I would love to see you over there if you're interested in some bonus content. I even plan on creating a Discord, a private chat group just for my Corner patrons this week. Now, before I go today, in terms of a full disclosure, I'm long Universal, ticker UVV. I'm long Altria, ticker MO. I am long Starbucks, SBUX. I am also long Procter & Gamble, ticker PG. I own all of those stocks in my personal dividend stock portfolio. In terms of a friendly disclaimer, today's video, it's not investment advice. I'm not a licensed investment advisor. Today's video, it's just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first. It's possible to lose money in the stock market and any kind of financial markets. I love you all. Thank you for tuning in. I'll see you in the comments below, and I'll see you in the next dividend stock investing video.